From the trading desk of dailyforex.com, this is Christopher Lewis looking at the upcoming non-farm payroll Friday, December 7th Forex session. And in front of you, I have the dollar Canadian dollar pair. This is one that a lot of traders make the mistake of ignoring during non-farm payroll Fridays, simply because the world tends to focus on the euro for whatever reason. My theory, of course, is that it has the smallest spread, really, and that's about it. But having said that, you have to think about the dynamics of this pair during a non-farm payroll report. The dollar and the Canadian dollar are very intertwined currencies because the economies are intertwined. Canada sends 85% of its exports into the United States. So think about it from an export market, or even a example of somebody who owns a general store. If you sell 85% of your goods to one particular person or one particular company, or in this case a country, and they are finding themselves unemployed or underemployed, then certainly they will be buying less of your goods. It is because of this that this pair tends to move counterintuitively to the announcement. In other words, if we get a great jobs number, the dollar falls apart against the Canadian dollar and this pair falls. Alternately, if we get a very poor number, this pair will typically shoot straight up because the dollar gains. This is simply because a lot of times traders are throwing money into the treasury market in the United States, and also it should mean less demand for Canadian goods. Specifically, oil is really what they tend to look at the most. As you look at this chart, though, you can see the technical setup has been pretty straightforward. I have this marked as a rectangle, but I do have this little area above, and I think this is a bit of a buffer. If we can get above the parity plus 50 level, I think this market goes much higher, and in fact I think it goes to 104, which was the top of a much larger consolidation area. Will this happen today? Probably not, but we could see a gain into that area. This is a pretty thick area to chew through, and you also have to think that by the time we get to that point, we would have been up about 150 pips, which is a very significant move in this pair under normal circumstances. However, I think if we get a poor number, we will see an attempt at the parity level probably during that day. It would only be about an 80 pip move. Doesn't seem like it's reachable due to this lack of volatility lately, but this pair tends to go to sleep and then you'll get candles like this. Alternately, though, if we get a very strong jobs number, we could see a breakdown, and I think a breakdown at this point in time has us heading towards the 0.97 level to look for support. Now, having said this, the one caveat we have this particular time is the fiscal cliff talks, because believe me, if the United States goes over the fiscal cliff and there are fears of a recession, this pair will shoot through the roof as money goes into the treasuries and demand for Canadian goods all but evaporates. So there is headline risk with that as well. But technically speaking, just from the technical point of view, this is the setup we have. And non-farm payroll is always an interesting day for the dollar Canadian dollar pair.